everybody. Thanks very much for joining us. Thanks also very much to everybody for making it in what is a rainy London and also an absolute nightmare in terms of getting here with transport this morning. So appreciate everybody for being here to talk about what is a very exciting market, I think, and lots of opportunities coming up. Thanks very much to CMS for hosting us again here in London. Great help as ever and great support to have you working with us. And on that note, I'm going to introduce Michał here from CMS. Firstly, thanks very much for inviting us here to CMS. And a quick welcome from you, Michał.
Thank you, Richard. Good morning, everyone. A warm welcome here to rainy London, but the welcome is warm. It is a pleasure to be here with you and talking about investments into CEE. I'm Michał Mieciński and I'm a partner at CMS Real Estate and Construction Department and based in Warsaw. And we are here today to talk and discuss the investment landscape and the current dynamics shaping the real estate market in the CEE. And the depth and resilience of the market have been tested over recent years. And today's conversation comes to a time when we need clarity, data-led insights, and practical perspective, and more important than ever. We are fortunate here today to have really a great panelists that bring together multiple vantage points across the investment ecosystem. We have institutional capital from PWS. We have financing expertise from Berlin. We have market intelligence from CBRE. Have I forgot someone? No. And our focus this morning will be both strategic and pragmatic. We will look at the macro picture, interest rates, pricing discovery, liquidity, and we'll delve into sectors where CEE continues to demonstrate strong fundamentals and compelling growth story, from logistics and living to select segments of office and alternative assets. This is actually a great time to have a conversation about investments into CEE. I don't know if you saw an article and a film and teaser of The Times, which was published, I think, 2 days ago, which fits very well into our today's conversation. Yeah.
The statistics show that the UK's post-Brexit economic performance has been so weak that Poland is projected to soon overtake Britain in GDP per capita. Kenny Badenoch told the Tory conference that Poland is growing twice as fast as we are, but twice does not quite cover it. In 1995, Poland's GDP per capita was $13,600 in today's money, about 36% of Britain's. Today, Poland's figure is $44,500, or 81% of ours, and it may soon pull level. 12 of Poland's 17 regions are now richer than West Wales, the poorest part of Britain. How has Poland done it? After communism, instead of selling off state-owned assets to a small number of rich individuals, Poland held public offerings and encouraged foreign ownership. More recently, it's enjoyed the sweet spot of being in the EU, but maintaining its own currency. Compared to Britain, Poland has faster internet, cheaper electricity, and more high-speed rail. The irony is devastating. The country whose citizens were cast as the economic problem is now on track to become richer than the country that tried to shut the door.
Very encouraging for Poland. It's made me feel quite miserable, I have to say.
You can understand, in a double way. Basically, either Poland is doing so good, or UK is doing so bad. But either way, I think it answers one of the cliches we are all having when we are thinking about CEE. This is somewhere, east, and maybe it is like still emerging markets, undeveloped market being like created. Whereas you will see it, we'll hopefully demonstrate it together with the panelists, that the market is really very developed. It's not emerging anymore. And actually, it's also not the market which is like the same in all the countries. But 2 countries, in particular, Poland and the Czech Republic, stand out. And actually, they might be already somehow transferring in terms of economy and the resilience of the market, depth of the market, towards Western Europe. It has benefits, but it is also like some problems with it. So hopefully we'll discuss all this together with the panelists, with the group.
Great.
So great to have you here. Looking forward to really interesting discussions, and thank you for coming.
Great, thanks, Michał.
Thank you.
David is going to give us a kind of quick overview of what we're seeing in terms of the investment trends within a European context, and then we'll pick that up in the panel. So if you could welcome David, that would be great. Thank you, David.
Thank you, Richard. Thank you, CMS. Lovely to be talking with you all this morning. I'm going to provide a bit of context. The real value will obviously come from our experts in the panel. As Richard said, I cover all of Europe in my research remit. And on the brief introduction we've had today, I'm very happy that I'm talking about CEE and not the UK. But let's get into it. Now, I'm sure you're like me. We're all bored of talking about tariffs. But it's really quite difficult to talk about this without starting here. Global policy uncertainty has been the highest it's ever been through this year. It's fallen back a bit recently, which seems like good news, but it's not going away. Look at the sanctions announced just yesterday by the US. There's going to continue to be policy surprises. And investment activity is not a big fan of uncertainty. So this has really put the improvement in liquidity that we were seeing across Europe coming through really encouragingly in the late signs of 2024 now on pause. I'm showing that on the chart nearest to me, which is European investment volumes, the quarterly numbers in the green bars and an annual rolling average in the grey. I should say that the latest figure there, the Q3 number, is a provisional number that will go up a bit, so it probably won't look quite as bad as it does here. But you see that things are on pause while investors get used to dealing in this more uncertain environment, which we believe they are doing. There's only so long you can sit on your hands, and we will begin to see people coming back, and we expect to see a relatively busy Q4. Interesting, though, if you dig below these numbers and think about Europe as a whole and the different parts of Europe, this hasn't been what you might call the classic cyclical recovery. We haven't seen activity picking up in the core and then rippling out further. We've seen real strength actually coming through in Southern Europe, where investment activity is ahead of historic averages. Then you look to a market like Germany, and investment activity year to date is still about 35% below what's been typical since the GFC. So not necessarily a typical recovery in this part of the cycle. But sticking with investment volumes and going in to look at the CEE region, here I'm showing the data slightly differently. So here we have year-to-date figures. The pale green bars show the percentage change from the same period a year earlier, so year-on-year change. But perhaps more tellingly, the dark grey bars show the difference over the same period on average since the GFC. And what we see in aggregate is that CEE has been one of the relative laggards, if you like. Those figures are pretty close to what we see for Germany, well down on typical volumes, and about even year on year. But really the key message from this slide is that we always aggregate the region together. It's convenient to do that. It summarises, it's easy for presentations, but there's heaps of diversity. These are really different markets. These are not one market. Now, we're going to talk about them as one market again, I'm sure, as we go through and summarise, but they are not one market. Just look at the difference here between Poland, where volumes are down year on year. They're down on typical volumes. Actually, the industrial sector is doing okay, but pretty much across the rest of the sectors, things look pretty weak. Compare that to the Czech Republic, not only up really strongly year on year, but above a typical or historical average. And that's quite unusual, actually, across European, across global markets. So real strength there, where we see industrial absolutely booming, and we see retail recovering really, really strongly. So just an important point to note there, that things are really different. And another differentiator here, which I think is also important to mention, is the source of capital. So in Poland, you're looking at a market very reliant on cross-border capital. Over the past year, about 85% of transactions would be capital from abroad. In the Czech Republic, that figure's only 25%, so a very domestically driven market. In fact, that leads me to ask, perhaps we will go on to see Czech capital as a really important player in Poland. And that's actually what we have seen over the past year or two. Typically, those check volumes would have been dwarfed by what we see coming from the US or Germany. But with those players out of the market a little bit at the moment, that check capital has been really, really important. Now, apologies up front, because having said there how important it is to think about the markets individually, I'm straight back to grouping them together. And here I'm looking at the capital value evolution on a cumulative basis since the second quarter of 2022. We have the green lines showing the evolution for Europe as a whole, and the grey lines showing CEE specifically. Now, the first thing I'm going to raise here is a bugbear of mine. And it is important that CEE does not have quite the same transparency as other parts of Europe. So when you look across this chart, you see there's no grey line for residential, partly due to transparency, partly because the living sectors are still immature in the region. But even when I think about offices, you can see here there are some dotted parts on that line where I've had to make some assumptions to fill in the data myself. Now, all of this is just a little bit of a complication when talking to global capital and thinking about that. So transparency is a consideration here. But more important, let's look at what the numbers are actually saying. They clearly show that through this correction, CEE values were more resilient than they were across Europe as a whole. But consequently, perhaps the rebound is not going to be quite as dramatic. When we think about yields instead of values, across all of the prime yields that CBRE track across Europe, they see currently about 20% of those trending stronger. When you narrow the focus specifically to CEE, it's about 10%. So it's not a huge difference, but a little bit less pricing momentum here than across Europe as a whole. Of course, the most striking thing to say here is just look at retail. That is really, really strong performance and something that we should all be monitoring closely. Now, I don't want to say too much on the occupier side today. I want to stay very investment focused, but it is important just to touch on this. Across Europe, occupier fundamentals have been resilient, and the story has continued to be positive. This chart shows some MSCI rental growth data and shows that 93% of the 210 city sector combinations they cover are generating positive rental growth. I've highlighted in grey there the ones that fall in CEE, and you can see that the vast majority of those also generating growth. We think that this is sustainable and that this will continue going forward. In fact, we see the nature of returns through the next cycle as very much being driven by rental growth and income growth, which is a big difference from the last cycle where we had the structural decline in interest rates driving a lot of returns through the yield side. But coming back to the investment market and thinking about investor sentiment, I'm showing here a couple of different surveys. The first chart shows some responses from CBRE's Investor Intention Survey, the second from ULI's Emerging Trends Survey. Now, admittedly, neither of these are the most recent. In fact, it's only a couple of weeks until we get an update on the ULI numbers, but the headlines are still relevant, and I think they still stand. When we look at the CBRE Investor Intention Survey, which can break down the responses between Europe as a whole and CEE, what's interesting to see is that when we asked investors reasons to increase real estate allocation, there was literally no difference at all between those focused on Europe and CEE. When we asked for reasons to reduce real estate allocations, we do see that there is just a bit more risk. Investors are just a bit more mindful of the risks in CEE than they are elsewhere. And of the ones on the list here, it's really that second one, geopolitical concerns, which is a worry to me, and I think will be to other investors. The other ones here, be they risks, be they concerns, I feel like I can have a pretty good attempt at pricing what they mean. Geopolitical concerns, very difficult to price. Now, perhaps some good news comes from the fact that this data is a little bit dated. And if I roll the clock forward to today, what do I hear people worrying about? I hear them worrying about an AI investment bubble, and I hear them worrying about deteriorating government finances. And you know what? On those two things, CEE looks pretty well insulated. So on today's risks, maybe not quite as bad as things look here. And the ULI data actually shows us that despite those risks, on a relative basis across European cities, investors have been becoming more interested in CEE locations, not less. Interest seemed to trough around 2023. I'm sure that has something to do with the events of 2022, but since then has been on a solid upward trajectory. Now, you might ask why I've put Madrid on here. Madrid clearly not a CEE market, but again, just to make that point, that this cycle is not following the typical pattern of being focused in the core with other parts of the market having to wait till later. Madrid has never been as high in these rankings as number 2. Now, what about sectors? Well, I think when we look back over the past decade, the past cycle, CEE was a clear beneficiary of the logistics boom. There was a very clear narrative as to why the region would be strong in that area. And at least through the second half of the 2010s, we saw a real clamouring amongst investors to build up their logistics allocation. They were doing that across Europe. They were doing it globally, frankly, and CEE was a big beneficiary of that. We saw that in the fact that logistics makes up a larger share of typical transaction volumes in the region than it does across Europe as a whole. Now, I've shown this slide actually a few times over recent years, with the big question I'm posing really being, if investors are now shifting their focus to the living sectors, how does CEE position itself in that world when it's more immature in that space? You see actually that CEE has residential only accounting for less than 5% of its investment volumes typically. I say I've used this slide several times in the past because actually this time I've modified it slightly. Because what if it doesn't need to be a living story? What if the retail renaissance, the enthusiasm that we see coming back for that selectively, what if CEE is a real beneficiary there? You've already seen how strongly it's been performing over recent quarters in terms of capital value growth. And we do see that retail is a very, very important part of the investment market in CEE. And actually, this is where our latest forecasts would guide us. So these forecasts are total returns over the coming 5 years. I've got all property and then the various sectors. And for each of them, I'm comparing Europe to our aggregated CEE number. What you see is that in most cases, they're pretty similar. And what I would say is that where they're pretty similar, it's quite difficult to build up enthusiasm amongst global capital for CEE because they expect to see outperformance. And that is what you do see when you look at, in particular, shopping centres or malls in the region. We've already seen very, very strong volumes coming through in the Czech Republic. And our anticipation is that this will begin to feed over into Poland as well. We've seen investors return for shopping centres across a lot of southern Europe. And we believe that with a lot of those opportunities now exhausted, CEE will be a place they look next. Now, I just wanted to finish by saying, with a bit of a caveat, I suppose, because we always talk about markets in groups, we always talk about sectors, we always talk about themes. It's a nice way to communicate, it's a nice way to present. But in reality, we see a shift occurring, a shift from where it was really important to be driven by those sectors and those themes, to one where actually the market and the stock selection is becoming much more powerful. I'm using an example here by showing some data first from 2017 to 2021. What I'm showing is the impacts on annual returns from, in grey, the sector allocation, in pale green, the country allocation, and in bright green, the stock selection. Now, this was an unprecedented period because you gained almost as much performance from your sector allocation as you did from the other two factors combined. Unprecedented in the history of the real estate data. But now we see a reversal. Actually, sector allocation is falling to the bottom of that table. Country allocation, and in particular, stock selection within the country and within the sector, we see as really powerful drivers of outperformance going forward. So just to wrap up before we get onto the panel, despite the fact that liquidity has been disrupted by the uncertainty, Overall, we still see this as an attractive entry point for European real estate markets, albeit we see the drivers as different. It will be income growth driving returns, not yield compression. We see the opportunity set as wide, and we don't want to be right now focused on particular sectors. Rather, we want to be looking at the more micro picture, thinking about individual markets and individual assets. But within all of this, investors do like a theme. And the new cycle leaves CEE markets, in my opinion, at the moment just looking a little bit for that new clear narrative which might pull global investors back in en masse. So that concludes all of the materials I wanted to talk through by way of background, and I'll be really interested to see how the panel respond.
Super.
Thank you very much.
Really interesting. So speakers, if you could join us, that would be great. First of all, David, a quick introduction from you, and then we'll work our way down the line just to make sure the microphones are all working.
By all means, I feel greedy I get to introduce myself twice. But, David Inskip, I lead the European research team at CBRE Investment Management. CBRE Investment Management, one of the world's largest real estate investment managers, and my team's role is supporting its strategy across the direct, indirect and listed platforms.
Great, thanks. Ruben.
Good morning, Ruben Bos. Very similar role to David, so I had the European research team at DWS, a global asset manager with about 30 billion invested in European real estate. Similar to David, I look after all countries, all sectors in Europe, so not per se, I would say, an expert on CEE, but I can give you with a broader perspective.
Hello everybody, my name is Wiśniewska and I'm Warsaw-based lawyer in CMS, real estate and construction team. Our Warsaw team is the biggest in Poland, and I'm happy to be here. On my daily work I usually focus on real estate investment, lately mostly PRS and logistics.
Great, Justyna.
I'm Justyna Kedzierska. Good morning everyone again. I'm heading the Warsaw office of Berlin Hub. Berlin Hub is a German mortgage lender which has been present and active in Poland and Czech Republic for 20 years, almost now. In August this year we joined our forces with our mother company, LBBW, being the largest Landesbank in Germany. So our combined commercial real estate portfolio amounts right now to over 60 billion euros. Thank you.
Thank you, Justyna. Like David, I've privileged to introduce myself second time. Michał Mieciński, a partner in real estate department of CMS in Warsaw. And it's also worth saying that CMS is present in all CEE markets with offices basically in every single CEE office.
Yes, Oleg.
Yeah. As well again. Good morning. I am a senior banker, which is actually not a rank, it's a title. We still use with European Bank for Construction and Development. It's a multinational development bank. I'm since last year based in Warsaw, before in London for many years. I'm a pure real estate focused banker. Focus is Poland, Ukraine, the Baltic states. So, yeah.
Great. So we've got a super mix in terms of expertise on the panel, both in terms of pan-European and also local and coming from different perspectives. And again, if you've got questions, if you've got perspectives you want to share, please do. It's a nice informal session here, so we can pick up on any views that you've got. Justyna, let's start with you. Just in terms of, we're not quite at the end of the year, but we're getting towards the end of the year. So how do you see the market at the moment? How do you see that in terms of your expectations at the beginning of the year? Where are we and how are you seeing the market?
At the beginning of this year, I believe that our expectations were a bit more ambitious than what we have seen in terms of the investment activity in CEE markets so far. So hoping for the best but expecting the worst. Well, maybe not the worst, but these expectations I'm talking about were awoken probably by the very strong months of the previous year, so 24. So Well, there is some disappointment in this respect, I'm sure. On the other hand, if you look at the figures, okay, David presented them to us, and specifically for Poland, even if there is a slight decrease in the investment volumes if compared with the same period of last year, in fact, if you look into the details, the number of investment transactions of slightly above 100 shows that there was quite a good activity. It's just the ticket size changed, which has to do obviously with the source of capital invested. So again, with over 100 transactions for the first 3 quarters of this year, and it's not yet the end, it's not that bad, even if those transactions are of a bit more opportunistic profile. So.
Okay, good. It'd be interesting to pick up as well with anybody that point around the capital flows, I think. I mean, if anybody's got a view on how they're seeing the market, and maybe Ruben, for you as well, just from DWS's point of view, how are you seeing that? Do you go along with David's version of it? How do you see the market from your side?
Well, I think 25 we're firmly in recovery mode. We're back to capital value growth. We're seeing that in indices, but also valuations. And with that, fundamentals look strong here. Interest rates are not restricted, I would say, in Europe, except a few countries, including UK. So I think that's all good. I think the part that's missing is really the liquidity, the investment volumes. You know, they're about 40 to 50% of the pre-crisis average. But we're slowly seeing some improvement there. We're slowly seeing capital returning to the market, whether that's German, European capital, overseas capital. So I mean, we're positive.
Okay, good. Does anybody have a view as well? I mean, it's interesting the point you made, I thought, David, about more trans-regional capital, i.e. Czech capital potentially coming in. There's also been the ongoing discussion about REITs and local capital, whether that would be coming in, but obviously there's Hungarian capital, still seeing South African capital coming through. So I don't know whether anybody's got a view on what's happening with the capital. Is it more inter-regional? Do we expect to see German money coming back? Do we expect to see international money coming back? Has anybody got a view on that?
We're mostly bottom-up kind of players, so we see deals and we work on them. So the capital flows question is not something that we would be paying particular attention to. But definitely liquidity is lower, and I mean geopolitics plays a role, especially I mean we have exposure to the Baltic states, and there you see it in much more, let's say, direct way than in Poland. In terms of what we do currently more of, we see that the local lending market is very healthy. And we have less of a role to play there. So we are kind of, in a very natural way, we are pushed to more complex structures. And then we have actually quite a role to play because, yes, lack of liquidity, we are relevant. So from that point of view, I can confirm that. But it's more of a bottom-up view than whatever German capital will be doing. So it's not something that we are paying too much attention to, but we are hoping that it will come. Because those joint ventures we're currently structuring, they will need have a liquidity event 5 to 7 years from now.
Yeah, feel free to go ahead if you want on that.
No, that's it.
Okay, talking about liquidity and source of capital, I think it shows that this is not the region is not one market, because if you look, as David said, at Czech Republic, for example, the money is local. They have developed REIT system, and the people are investing in REITs, and they have really money to invest into real estate. Whereas look at Poland, we don't have REITs. There's been like a long debate introducing them now. And we all hoped really that this will be pushed through. And suddenly, the government dropped the idea. If you look like at the history of all the governments in Poland over like last 20 years, all of them are very much afraid of REITs. They're afraid that people would invest into REITs and lose money. They are very much afraid of REITs investing into residential, and because deals collapsing and people losing maybe homes. So basically, they are not supporting REITs at the moment. They said it's like on hold. I don't know, Justyna, if you agree that we don't have much hope to go through very quickly. So if you look at Poland, for example, we can talk about intra-regional transactions, because on the Czech market there is liquidity, there is money, but there are not that many like investments or assets to invest. So the Czechs go abroad, not only to Poland, they go to Germany, using the opportunity and buying cheap, given the condition of the German economy at the moment. Mm-hmm. So we see like over 2 or 3 years, capital coming from countries which we never saw before. Czech Republic, Lithuania, a little bit of Hungary, but also like last year, increasingly investment from Polish businesses investing into real estate. Like some of transactions recently on the market, they were financed and bought by Polish individuals having businesses. So like 2024, local capital was about 10%. Now it's roughly 23-24%. So we see increase of local capital, but it's not enough. And as David said, we are very much dependent on the capital coming from abroad. What we are still missing, probably Justyna agree, we are missing this core capital from Western Europe. Okay, there are now and then transactions from Germany or from France, etc., but it's not the volume we would like to see at the moment.
Yeah, Justyna and Anna, pick that up. Yeah.
Yes. Maybe just very shortly on this Polish part, or the part of Polish capital, we are of course extremely happy to see this figure increasing, even though there are some owner, occupier acquisitions, etc., also some from public institutions. But still, with this appetite and this source growing, we also hope that even though the REITs did not come true and probably we will not succeed to have them in the next years, there are some other ways to strengthen our domestic part of the market. Unfortunately, CEE is definitely not the main interest right now of the global players, and we obviously very much regret this.
But interesting that you've got, so that's double, and are they actually then buying, is this high net worth, is it people buying an asset as if they're an investor, or is it actually people buying their own properties back again? What's the situation?
I think it's both, but with more focus on the real investments into real estate. I mean, people who made their monies in some other industries, etc. They are just right now perceiving. They have always probably perceived the real estate segment as an attractive opportunity. It's just they were not in a position to compete with the big players. This is first thing. Then obviously they will not be targeting like 100+ million euro assets, but start in the smaller segment. That's why the average volume of transaction which we had this year is much is quite smaller than what we saw in the past. And in fact, indeed, with Czech investors or some other CEE investors, we also treat them already for the last 2 years like a kind of a quasi-domestic capital. So welcoming them, obviously, because they are like kind of stabilizer, kind of stabilizing element for the market from our perspective.
Okay, good. And Anna, you want to pick that up?
Yes, I want to just share the comment I received after the expo from one of my clients who had plenty of meetings, as usually expo is all about. And the comment he received was, while he talked to one of the potential investor, he said that no, we are not interested in Poland because the lack of liquidity, because we don't have Polish capital enough, then we don't have a stability, like the possible disposal of the asset is not secured for us, and it's because of many reasons it's not acceptable for us. And then the next meeting he had with other investor, he received information that no, we are not interested in Czech anymore because there is too many local capital in Czech Republic. So when it comes to the objective reasons why some specific regional jurisdiction of countries are considered as not interesting enough, like you might encourage very different approach. However, when it comes to Polish capital, as Michał said, we don't have formal REITs, but my personal experience is that last 5 deals, 4 PRS deals and one office, I represented institutional investor against Polish capital. And totally agree with Justyna that the size of the deals were not what we would like to see yet, but the Polish capital is very much in, and especially when it comes to the residential sector, but also, as I said, logistic, because those two sectors seems to be the most resilient and stable against all economical odds. And maybe just a not very legal, but general personal comment again, that I think that the Polish grow, and we did not sponsor Times video we just played at the beginning of the conference. We have nothing to do with that. It's just a coincidence that I think that the Polish economy grow, and actually it's not because of the very smart government or political move. It's actually against the politics, and I strongly believe that this trend will actually last for quite a long time in the future.
Okay, good. Ruben, feel free to pick that up, but I also wanted just to drill down a little bit into that. And from your investment side, you've got to get through things. The investment committee. You're seeing different sources of capital, whether that's North American, Asia, Middle East. Are they seeing, let's say, Poland and Czech in a completely different way to the other areas? Does that suggest there's more liquidity there? What are you seeing?
Yeah, I'll address it as well and go into the liquidity point. And basically, why is there a lack of kind of German, APAC, other European capital, potentially US in the region? Is that, I think, people see the strengths there, the economic growth, the structural drivers, etc. And they know, there's perceived risk, etc. I think the key thing here is that there is really good value in the other European markets. And if you go back to David's slide and you looked at the repricing, core European markets have repriced on average about 15 to 20%. Whereas the CEE market, I know we're overgeneralizing, is about 5 to 10%. So if we're looking at deals at the moment, logistics in Europe at 5.5 yields, new build. It's very close to the yields you're getting in the CE in Poland, for example, at 6. So to a lot of investors, it's easier to go for some European deals now because of the repricing and get that through an IC. And especially if your IC is non-European, if you're looking at APAC, Korean, Japanese, it's much easier to get a German deal through than it is a Polish deal. Still ask questions about, what's the proximity to the war, etc.
Yeah, and that's interesting. And certainly that reflects some of the conversations I've had with UK denominated capital, where they're not going to step over Germany at the moment. They're looking at Poland at the moment and CEE, but actually they're seeing deals in Germany that they want to get through and then step across.
And I think that German capital point is important, because actually it's not that German core capital is absent from CEE but very active in Germany. It's absent everywhere. So investors are actually asking them, before they get to ask themselves the question, does this provide an opportunity in CEE? They're asking themselves, is this an opportunity in Germany? And they're saying, yes, I think.
Good. I wanted to pick up a little bit in terms of the sectors in a minute, because I do want to focus on not just the challenges but the opportunities here. But Oleg, you mentioned that liquidity in terms of the financing side was less of an issue. And it'd be interesting just to pick up on your views on that, whether that's true in all areas, whether that's infrastructure, whether that's also, real estate specifically. And then it would be interesting to get your view as well, Justyna, on that, given the financing side.
I mean, what I meant is actually like senior lending is more or less available. So the banks are liquid and we buy them. Just we're limited by our mandate how hard we can compete. Actually, we're not supposed to compete with our local lending markets. In terms of sectors, Michał, if you want me to just quickly comment on this, I mean, you wouldn't be surprised, but it's living sector for us, number one priority. It's part of our strategy. Let's say living in general, PRS, now more and more residential for sale because it's where the scale is. for us. And for us, it's about quality housing and hopefully more affordable housing, but no one has a one standard definition for that, so we are like a bit freestyling for now. Then, of course, industrial logistics. I mean, we have a very large portfolio, and we continue to grow it. And I would say secondary priority would be data centers, but it's like the flavor du jour, and it's nothing particularly. But we haven't seen that many deals. We're just looking at them. And maybe retail parks, I would highlight that, especially in Poland. It's something of a post-COVID, let's say, winner, and we currently have exposure. We have strong relationship with big CEE, invest in Balkans. They're growing in Poland. We have a co-investment with Miecińska, with a, let's say, very clear focus on Poland. So hopefully we'll grow that portfolio. So in terms of sectors, I would say they are not that different from what you would expect, given the fundamentals.
Okay, good. Justyna, let's pick up your view on that.
Well, as for the liquidity of financing, definitely it's very heavily there. I mean, we are in an extremely competitive market right now, which we have not seen for some years. What we are right now also seeing is that our refinancings of loans resulting just from price competition, which is also a kind of new development in the market. This is not what we experienced in the previous years. As for the segments, well, obviously, from my perspective, I mean from Berlin perspective, the most attracting segment for us would be the core segment. I mean, core properties, etc. But life is never that easy. So we are of course also very much interested in other market segments as well. And independently, this is kind of a lesson that we learned over the last years. Independently of the market situation, current trends, expectations, etc., in every segment, you will find good opportunities. So David said in his presentation, like it's not about the segment, it's about identifying the right asset, picking the right asset. I fully agree with this.
Yeah, just to give you an example, I totally agree with Justyna and what David said in his presentation, that it's not about sectors, it's about a specific asset and actually knowing the business, because I'm concerned that we will not know the kind of real estate commercial real estate market as we know before the pandemic and before Ukrainian war. I strongly doubt whether the real estate business, like at least from the Polish perspective, will be such a bread and butter as it was before. Because to some extent it was a pretty simple business. Like acquire good asset, then hold it for 5 years and sell it with pretty decent income with very cheap money from the banks. It was like great revenue and valuations were stable. As I said, bread and butter deals. I don't think we're gonna have this kind of deals anymore, and we will definitely require more on-ground expertise. Just to give you an example, I've got a client for whom I work for over a decade, and I help them build a portfolio of Polish office A-class assets. And right now they are actually deploying the portfolio one by one because they didn't find a client for a whole portfolio, and they are actually selling it mostly to Polish entities, but with not extra result as you might expect. But the same client actually acquired 3 distressed assets, also offices, and their valuation and results are actually mind-blowing. But both portfolio were acquired from different funds with the support of different asset managers, and the idea of the business for both of those cases was totally different. And one was a huge success, the other not so much. So I think it's quite a good example of that it's hugely important to actually understand the underground business in detail.
Yeah.
Yeah, and the investors are successful in selecting the assets. If you look at the most successful retail transactions last year in Poland, again, like South African capital, Nepi Castle, but they did transactions each around 400 million euros. And they have like vision what to do, and they are specialized. You mentioned like big CEE, this is Israeli investor into retail parks in Poland, in Serbia, in Balkans. They started in Poland like roughly 3 years ago. From zero, they are now opening about the 20th retail park, doing it with us. So if you have like a vision as an investor, what you want to do, and you are picking right assets, you are doing that. Also Germans, because we are saying that they are not investing. They are. Obviously, this is not the volume we want to see, and the question is whether we see that volume from before the pandemic and before the war. But still, like this year, the biggest investor into a residential sector in Poland was a German fund. And if they see, like, we had a transaction in the hotel sector when the German fund was really very keen to buy it, and they did. So it's like more asset focused, I agree, and about the resilience of your business and idea how you pursue the business.
Okay, good. Let's drill down a little bit into the sectors. Ruben, I'd be interested to get your kind of view, and of course, if that's different in terms of different regions, also highlight that as well.
All right, so let me start with residential, as got mentioned a few times. I think residential for us is a key strategy across Europe, and we would love to do more in Poland and CEE. The only issue for us is for our investors hedging, because it's in local currency, and a lot of our investors require hedging. And basically hedging will kill your returns and get better returns elsewhere. Otherwise, living sectors, residential, student housing, senior living, very high on the agenda. Fundamentals look very, very strong. I would say logistics for us CEE is more of a mid-term performer. At the moment, we're seeing better value in terms of yield and rent growth in other markets, where supply is a little bit lower, vacancy is lower. Then in terms of retail, I agree with David. I think that looks quite attractive in the region. I think you need to be very selective in Europe. There's a few pockets. It used to be UK retail parks, but I think that has kind of repriced and is getting a little bit expensive. Iberia still works, but we like CEE mainly Poland and particularly factory outlet centres.
Okay, good. David, I noticed in the sector slide there that actually there wasn't really a figure for CEE in terms of living either, interestingly. Is that because, as far as you can see, the data isn't there, or that it's just from a house point of view, you're not necessarily looking at that?
No, it's a transparency point, really. So having the depth of the market to then provide the data to be able to say things confidently in aggregate, and we don't feel that we're there yet, so we don't have that coverage. We see that the market is moving in the right direction. We see that it is moving towards maturity, and I'm sure we will be including it over coming years. And then you get to have the more interesting discussion, which is the one that Ruben's sort of already referred to, whether you can justify your hedging cost from the outperformance that you think you get there. But at the moment, perhaps that discussion isn't even as well informed as it needs to be because of those transparency issues.
Okay, good. It'd be interesting to see what the kind of local market view, in a way, is, particularly on, I mean, you mentioned a focus on the living sector. It'd be interesting also to see, how far ahead are we with senior living, student housing, obviously doing quite well in terms of Poland especially, but interesting to see what the views are on the living sector.
I had the comment, and actually what was mentioned by Ruben, I mean, the hedging question, I mean, it's a big one. But how we started with the PRS segment 3-4 years ago, we started providing debt, holdco level debt, senior debt, and then we got more comfortable with PLN-denominated leases. So when we had that level of comfort, now we are more comfortable by actually co-investing with developers and creating new product. And for example, the deal that I think was mentioned, the PRS portfolio recently traded, we provided financing, I mean, historically to the seller. So you kind of learn and you see the performance and you get more comfortable. In terms of senior living, I have to say we don't see a lot of that, and we are kind of a natural co-investor slash lender for this sort of new segment, but we haven't seen much of it. PBSA is definitely a big thing. I would say PRS, PBSA are the two priorities within the living sector. Plus resi for sale, but it's a segment where we struggle, I mean, with the affordability point, because we have to somehow demonstrate that, and it's not very straightforward. So, I mean, and then maybe one challenge that we're facing with the living sector in general is that it's a bit hard sometimes to justify development spreads, because you need to create value, and development spreads are pretty tight, and then you look at the potential yields when you're going to be selling, and then you need at least 100 basis points to see some sort of a return. So I guess that the investors might struggle more with that, plus the hedging problem, and then you actually have a challenging math for investors. But we are, we're a bit braver by our mandate, so we are, let's say, looking very closely currently.
Okay, good. Interesting, because there are people actively investing from Nordics and from other places in that area, particularly if I look at Poland. So not necessarily senior living at the moment, but that's kind of on the agenda, I think, coming up at some point. But how do we see the living sector? Just to get your view, Anna. Yeah.
I'm happy to pick that, because one of my clients, he in the new fund that they gathered, the senior living is as an optional investment. So basically, I totally agree with Oleg that the sector is not yet there. However, we as CMS Warsaw, we organized a debate and conference in this respect in November last year. And it appears that we all agree that there will be senior living as a subsector of PRS investment happening in Poland. The question is only when, because they are developers willing to do that. They are even operators willing to do that. They are legal forms to actually make it happen. We can, I could talk about the possibility of structuring this kind of deal for hours, so please, I will not get into details into that, but definitely there are possibilities in here. The only thing which is quite missing right now, it's still the capital ready to finance that. And I took a few very interesting discussions in this respect, and there is an interest, but there is no deals yet. However, the market exists in Poland, but we've got senior housing projects in Poland, but they are up to 15 beds or 50 beds. So this is not the scale any investor is interested in. But the first investor who will actually be brave enough to combine the market, unify the market, and provide investors quality services, that there will be definitely a place to do so, and there will be definitely opportunity to possibly deploy such investment in quite a time. We actually have only one institutional investor. It's previous ORPE, currently EMEA, existing and operating with huge success in Poland. They've got great financial results. They are publicly available, so no surprises in there. And they actually would be very much willing to expand in Poland, but the global policy of EMEA doesn't allow to invest more in Poland. However, they've got appetite for much more, actually.
Okay, good. And does Ruben, maybe just pick that up with you. Does development make sense for these kinds of living subsectors, whether that's operational like student or operational like senior living, but low care, if you like, so more of a living concept rather than a care concept? Is that something where international capital might be able to get the returns because of the development side, or how do you see that?
Well, just a comment on the overall development profit margins. I think if you look at resi and office, I don't think development margins are there yet to develop. So there's a big rents aren't high enough to develop in across Europe. I think only for logistics it quite works, so you still see some supply there. So for us it's really hard to do that development. If you look at senior living student housing, they're typically valued at slightly higher yields than multifamily. That means that your valuation is going to be lower if the rent is the same. So rents need to be higher. What we've seen in Germany, for example, is that for senior living, in order to make it work, rents have to be 30% higher than traditional, on a like-for-like basis, excluding services. And that's quite tricky because that becomes a premium product then, living. So we would love to do more on that, apart from the hedging, but I don't think the development returns are there yet to do it from our side.
Okay, good. Let's drill down into some of the other sectors. I mean, for quite a long time, nobody's really wanted to talk about office, but let's see. What's our view? Obviously, particularly in the Polish market, but also in general across the region, you tend to have newer developments, newer buildings. But what's the sense at the moment? Is office still an attractive opportunity from either an investment side or indeed a financing side?
Shall I kick off with a bit of European comment perhaps, and then you can drill down into the individual markets? I think, we will begin to talk about offices more again. Everyone is familiar now with the bifurcation theme that operationally best-in-class assets in European city centres have been performing very well, even though we acknowledge there's a wider oversupply when you get into poor quality stock. But it does feel that is beginning to turn a little bit in some of the key markets around Europe. If we take London as an example, what we begin to see is that more of those sort of blue chip tenants that you would expect at the end of a 10 or 15 year run to move to a new building are beginning to actually say, oh, we don't really have enough option. We're going to stay here and we're going to work something out. So you begin to see that operational strength for the very, very best buildings beginning to trickle down into the next tier. So we're not talking about peripheral markets, or we're not talking about poor quality buildings, but we're just talking about a bit broader strength in the market than just talking about the top slice. And I do think investors are in the early stages of beginning to take notice of that. And I do think that we'll see interest improve over the next 12 months. Whether we ever get back to the point where office was such a key dominant part of the overall investment market as it was previously, I'm not sure, but I do think we're going to see improvement.
Okay, good. What's the local view?
Okay, like for Warsaw and for Poland, A-class offices are shrinking. So there is appetite for that type of buildings. On the other hand, there are like many old buildings, old offices, and I think this is the phenomenon which we observe also in the other markets. There are lots of redevelopments. So these old office buildings are redeveloped into, name it, like student housing or hotels. There are like a dozen of projects like those across Poland. And also I think we have the same situation as in the UK. We had our annual conference last year in London, Real Estate Conference, and there was a presentation of Canary Wharf. So how Canary Wharf is changing now, how it's like being purpose redeveloped. And there was like a great picture shown of HSBC, old building, how it's going to look like. And I think the same phenomenon we see in Poland, and you have like huge investments into actually now mixed use investments. If you look at the big investment in Warsaw of one of the biggest Polish developers, Echo Investment, and Israeli AFI, which is the mixture of office, residential, living, but also having fun, restaurants, etc. The same developer develops or redevelops old Mokotów buildings close to Galeria Mokotów. And these projects are very successful in terms of offices, but also residential. Like the prices, like this is like a project called Towarowa. For residential, they are like exorbitant, I would say. Like I don't know how the people are buying for this price, but there is still appetite to buy close to the offices apartments, right? So maybe this is the future of offices. So not the towers only, but still there are like investors like Skanska, for example, who are still investing in that sector. Although we're redeveloping as well. So as I perceive it, this will be a mixture of basically everything, but with a really strong accent on mixed use investments.
Okay, Justyna, let's get your view.
Warsaw is definitely a very specific market. I mean, the new supply is not sufficient to support the further market development. Warsaw is very strong, still attracting newcomers, I mean, from different industry segments, etc. So Warsaw is definitely no doubt. There is and there always will be a huge competition for prime product. But I'm also, not maybe quite optimistic, but a believer in the regional office markets. The regional office markets suffered just due to the cycle. So as the developers moved from Warsaw, which was at that time quite saturated, everyone said, they moved to regional cities, they started to deliver new products, and the pandemic came. Then obviously people were no longer present in the offices. Then the companies, so the tenants started to redefine their leasing strategies, etc. And we are still in this phase. I mean, certain companies are shrinking their spaces, reducing their staff, but at the same time, some of them are consolidating people, not just from other locations in Poland, but also from other abroad locations, etc. So I think in the longer or medium-term perspective, the sentiment for regional offices will also be better. Obviously, the prime product, the newest product, the greenest product, and most ESG compliant product will always find, will always be treated as an attractive investment opportunity.
Okay.
I could actually comment on what Justyna mentioned regarding the ESG requirements. Like in general, as Michał said, we've got plenty of opportunities and older office buildings, but in general, we've got relatively, definitely in comparison to Germany of rest of the Western Europe, we've got relatively young office stock when it comes to buildings. So they are, so the costs regarding refurbishment, capex costs are not so high to actually make those buildings meeting plenty of ESG requirements. And we've got obviously EU directives, which actually impose obligation regarding embodied carbon emission, operational carbon emission, etc. And this is not an option anymore, it's actually obligatory anytime soon, so there will be no possibility of actually making any acquisition from institutional fund not taking into account the ESG requirements and those elements, also possibly including capex investment of the possible products. And to this extent, I think that possibly office investment might be a good element of the bigger European portfolio, because they actually might increase possible scoring regardless whether it will be, red scoring of anybody or any kind of other ESG scoring or reporting. So to this extent, I think Poland stands out in comparison to the region. So that's the one thing. And the second point is that definitely there is shortage regarding office premises. Every time I spoke to any client regarding leasing a significant office space in Warsaw, there are possibly two options on the table, with the commencement date in 2027 and question mark regarding whether this project will actually be completed. And there is basically a race between the agencies and the tenant regarding leasing those spaces. However, I totally agree with what Ruben said, that there is a significant risk regarding development costs and difficulties regarding solid projections concerning valuations towards the costs. So definitely developers are in a hard spot to actually make the business possibly profitable and determine the possible income in the future. However, they may be places for investors to come and maybe consider some alternative solutions regarding financing, sharing the risk in this respect.
Okay, good. Let's pick up a little bit on logistics. We had a session about 3-4 weeks ago, maybe in London, on CEE and Polish logistics especially. And there was a view that because of some changing regulation in Poland especially, in terms of zoning, that it would become much more difficult. So therefore, if you had the land and it was zoned, you were going to be in a much better position. And for sure, they were seeing there a lot of opportunity, both coming from, the new defence spending in Germany, but also, increased nearshoring and the effects of that, particularly for the CE region. So I don't know if anybody's got a specific view on that. Maybe Ruben or David on that. How you're seeing it from your perspective, the region in that sense.
Yeah, I mean those things have been clear tailwinds for some time in terms of nearshoring, in terms of the value that the region brings to pan-European supply chains. I think those things are clear. We're, as a house, I would say, a little bit cautious on the boost that defence spending might bring. I think we see it probably more as a welcome offset to maybe some headwinds elsewhere, like in the automotive supply chain, where we see very intense competition coming from other parts of the world now. So welcome developments, and we still see strong demand there and the tailwinds. I don't really have a view on the change in zoning, though. That's something I'd certainly be interested to hear more about.
Maybe just a couple words before we go to the zoning. I think we agree with David. I think for us, Poland CE is kind of a mid-term performance in terms of capital allocation and logistics. We see the economic growth, we see the increased defense spending. We know German fiscal spending is going to kick in. It's been a bit delayed, but I think that's going to give a lot of tailwinds here to the industry. But I think that's going to come in a few years from now. So it's clearly on our agenda and our radar. The zoning, however, could be a game changer. I'm keen to know more about it.
Maybe
Let's do a brief version of otherwise I will direct you to the previous session that we had here in London. But briefly on that, if you've got a view on it, and if you haven't, and it's somebody else's department, I'll come back on it. But
I might have quite a controversial view on that, so I'm not ready to share it, especially when this presentation is recorded and broadcast. But what I can say for sure is that in Poland we have very flexible zoning regulation for ages in comparison to the rest of the Europe. So it was relatively easy and not so much time consuming to perform a development since the moment of acquisition, the property, to the moment of actually admitted to occupation of the investment in general. Someone might not agree, but I think that in comparison to different countries, it was fairly flexible. So it won't be anymore. So so definitely the business will get much difficult to the developers. That's for sure. Definitely the entities with strong and interesting bank of land will have a huge advantage towards the competitors. That's out of question. And as I said, there will be no bread and butter real estate business in Poland anymore. Like definitely expertise will definitely count. So what I can say is to encourage anybody interested in investing in the region to actually find good partners on ground. That would be my very strong recommendation actually in this respect, not to get into details.
I quickly wanted to just touch on data centres. Greycoat obviously invested. Is that an opportunity? Is it an opportunity just for specific investors? Any views on that?
I mean, just started frankly speaking. So it's for us it's a journey. It doesn't. Okay. So we do have some exposure to, let's say, pan-European platforms that actually look at CEE. So that's one way for us to support them. Recently in Poland, we started looking at one potential transaction, which is much smaller scale, not hyperscalers, but let's say much smaller data centers. And we are just starting due diligence. So hopefully the kind of, the results of that will be sufficiently positive so we can let's say, move forward. But we haven't seen much that would be, let's say, Poland focused or Czech Republic focused, and let alone Baltics focused. So it's much more of a kind of niche thing. And potentially for us, where we can support developers or consolidators maybe, that would be the right word here, is with the smaller, let's say, kind of sub 1 megawatt, whatever is kind of something much smaller scale.
Okay.
Well, I can definitely see the appeal of data centers, the demand drivers there, the structural drivers, etc. And in our view, it's both infra and real estate, depending on how you structure it and the ownership. But to us, I think the value actually sits in the infrastructure side of things, by being the owner-operator and operating the site, rather than owning the shell, the land, and then a long lease to a tenant. Because those are, very keenly priced and large lot sizes. So you're looking at 100 to 200 million lot sizes. It yields, at least in Europe, starting with a 4. And you can buy logistics at 5+ at smaller lot sizes. You can buy more. So to us, it's more of an infra play.
Okay, good. Does anyone have a question that they wanted to ask, or a burning desire for something that has yet to be covered? Yeah, go ahead. Yeah.
Just maybe touch on, David, you spoke about the returns on a retail front for malls and slight mention about retail parks. Interested in how you incorporate the supply side into that, particularly in Poland. You've got a lot of, I say, existing shopping centres that are either adding space, upgrading, they're very new as it is. So how does that supply element play into those forecasts? And then I guess also in a retail park when you've got 300,000-400,000 square foot of retail parks on the way, and how do you price that in from a lending perspective?
Great. Anyone else? And I'll take. Yeah, Mark, go ahead.
Yeah, David and Ruben. What's your view on the other CEE countries that might come in? What's the next boom market? Serbia, Croatia, Bulgaria, Romania. We talk a lot about Poland, Hungary, Czech Republic. Where should we look next, or where do you think investors will look next?
Okay, great. Any others, and then we'll take them all at the same time?
Just
maybe
one question on power. Poland is relatively kind of dirty as a grid, and there's a lot of investment needed to clean that up a bit. Do you see an impact on energy prices coming from that investment required, and any kind of risk to maintaining that relatively low cost of power through Poland?
Okay, good questions. Who wants to pick any of those up?
I can start with the retail point. We don't have a clear track up. We don't forecast returns for retail parks across CEE, but we do for the malls. We're running out of battery.
The only one standing.
And I don't see those things as a massive concern. What we get to is a situation where we're essentially saying we see opportunity within the market rather than necessarily buying the whole market. I don't think there's anywhere in Europe right now, even in a Spain or a Portugal, where we would say we want to buy an index of retail or shopping centres, but we see markets where there are opportunities, and seeing now with the pricing move on so quickly in Southern Europe, the opportunity set perhaps being slightly exhausted even in the Czech Republic with the amount that's been transacted there. We do think that there will be opportunities in Poland, and I think when the new supply is coming through as perhaps extensions to existing schemes rather than new competition, actually you can interpret that as a positive, whereas you might typically interpret the new supply as a negative. So that's our view, that there will be opportunities, but it's not a sort of buy the whole market thing anyway.
Anyone else have a view on that point about the retail side? You mentioned also about the financing of it, I think.
Retail parks. I think it's also important to say that that might not necessarily be competition for big shopping malls, because these are mostly located in big cities. If you look at the business plans of those who invest into retail parks in Poland, these are regional cities or very, very regional cities. So they look really into places where there's literally nothing. So answering this question, there will be like probably no competition between them, yeah, because they are like addressing different sectors, different market sectors.
Mm-hmm. Yes, this is definitely a different market segment. The older schemes are quite well established in the market. Obviously, some of them require some reconfiguration, some new ideas maybe in the parts of the city which developed strongly or in some other directions than previously expected. Retail parks is a totally different market segment. Firstly, for a lender, if you would like to finance a construction, it's not something for kind of more mortgage lenders. Really, it's more for the local banks where they they've got their administrative setup to support the construction, financing, etc. And then from my point of view, the only kind of interesting, let's say, setup would be to have a kind of a portfolio. But then entering into the portfolio, you are not in a position to really assess very well each and every location, because they are really very local specifics each time. And of course, you can ask the question, okay, how do I make sure that in 2 years there will be no competitive product just, I don't know, half a kilometer away from the one, and the new one will be stronger than the one I've got in my portfolio. So my answer to this would be that you just need to have a good partner, experienced partner, and obviously the available leverages for such a product by definition will be more conservative than, let's say, for a core office product in the very central location in Warsaw. Yeah.
Go ahead.
Just fully second what Justyna just said. And actually, we look bottom up when it comes to retail parks. And there, I mean, yes, secondary, tertiary locations, smaller projects, but I would say that pushing leverage materially beyond 50% would be quite hard. We wouldn't normally do it because, yes, I mean, there are concerns, and when you finance portfolios, I mean, it's just a different consideration. So you look at in much more holistic and less detailed reporting. So yeah.
Okay, good. And for those who are active outside or have a view on outside of Poland, where are the new hotspots that Mark is looking for? Where should he be looking? And Ruben, you can decide whether or not that's where actually DWS might take you, or where you might decide.
Very good question. It's interesting that you asked it to the kind of non-locals here, and just to preempt a little bit, I'm not an expert on all the CEE countries, and if you look at our investors, our funds, they have either a global allocation or European allocation. So that by default means that the CEE allocation within those funds is relatively small. So, if you're talking about a billion fund, it might be one investment in the CEE, and that investment is likely going to go to Poland, given the liquidity, size of the market, but also the fundamentals there. And then you would maybe venture out to Czech Republic, etc. But to try to give you an answer, I don't single out countries, but I think what would help from our perspective is euro-denominated rents and a story. And the story being nearshoring, new trade routes, or something else. So the countries that can adopt the euro, have that story, could benefit from that capital. But it will be, pushing water up the hill in an IC if you're going to try to convince CE and then even the smaller countries. But I'm ruled out.
I want to make sure that we've got enough time for networking and discussions afterwards. So if anybody's got a brief view on the energy side, I'll pick up on my view that I'm seeing from it when I've been in the market, which is that you're beginning to see, certainly if I look at logistics developments, that actually a lot of those are looking to move to being off-grid and actually provide their own solar, which then means that it's then green energy. So that's one way that's moving ahead. If anybody's got but I mean brief, not so like 30 seconds.
Okay, so I agree. When 6 years back, I was requested by my client to actually work on the BTS project, will be energy sufficient, self-energy sufficient. That was a totally new thing to me. But then we performed the building, and in the meantime, before the completion, we had the COVID and the shortage regarding gas electricity. So that's a quite a bold and genius decision of the client, of mine. However, please note that in Poland we've got plenty of investments regarding nuclear plants. The one supported by the government, a huge nuclear plant, but also small ones financed by private equity funds are still considered by us as quite interesting options, and there are plenty of this kind of investment, including also photovoltaic plants all across Poland. However, I totally agree with you that we are very much coal dependent, and it won't change within a few years or the next few years. However, it's changing, and we are, going to the good direction. And to my knowledge, energy prices are not so high in Poland in comparison to the rest of Europe because of the governmental support.
Okay, great. Final 30 seconds each, and let's see whether or not we can get an answer for Mark out of this one in a way, which is where are the best returns? Where should you invest at the moment? And maybe that'll be regional Polish cities. I don't know, Mark, for your point, we'll see. Okay, so 30 seconds each, or less if you've got a quick answer to that. Let's start with you, David.
Well, I think I've already outlined the case, and I'm going to say Polish shopping centres.
Okay, Polish shopping centres. Ruben?
I'd say living unhedged.
Living unhedged. That sounds like quite a lifestyle choice.
I will give you a lawyer's answer. It depends.
My answer will be the same, even though I'm not a lawyer. So it depends, but definitely living segment is full of opportunities, even if not always easily bankable, also due to the currency risks, etc. I would say, again, in every segment you can find good opportunities.
I would say living, but including alternative asset classes, student housing including, and also hotels. There was an article in The Economist the other day that people are dropping really luxury shopping, but they are not dropping spending money on leisure, on tourism, on staying in hotels. And we have been touching this subject here, but hotels are really booming in Poland right now.
Okay.
I have to pair it and say living, just because it's fundamentals are so strong. Then maybe BTS logistics with good credit tenants. Maybe some brown to green conversions. I mean, if your cost basis is, let's say, sufficiently low, we would love to support that. We haven't seen much of that, but I hope that will come soon. Yeah.
Okay, great. Well, you'll be able to share your private view on where you should invest if it's outside Poland, or indeed visit if hotels are booming. Might be the easiest route to that. Thanks very much to everybody for joining us here. We'll write this up, and that will be available in the next issue. It'll be available online, but also in the next issue of Real Asset Insight. And if you don't already see that, John can help make sure that is available. So thanks very much. Thanks to everybody for watching it on demand, and enjoy the networking, everybody. Thanks very much.